and then everyone's say their name. Maybe we can go in order. My name is Mike Sheldon.
Tom Harvard is here.
Derek Moore is here.
I'm Charlotte. Can you
Brendan
guys hear
Terry.
me?
Yeah, we can hear you, Charlotte.
Oh, okay.
Okay, so everyone's checked in. It also said if anyone would like to share any type of spiritual thought or some kind of related activity, this is the time. You have 5 minutes. Is everyone okay with the 2-hour block?
Yeah.
No complaints there?
I think it'll be really good.
Yeah, I think it's sweet. I'm in nursery, so nursery will only be 1 hour, which would be nice.
I have a 2-year-old that won't stay in nursery, so
Well, there you go. That's mutually beneficial, I guess.
yeah.
It should be interesting. I didn't really think they do it, but it actually happened. So, but I'm not
It's pretty
complaining.
crazy.
So, okay. Well, we'll jump into it. So the first question is actually for us to do a vote. It said, should Madden go for the Babies R Us opportunity? So maybe start with you, Derek. What do you think?
Say that one more time. Sorry.
Yeah, we're supposed to take a vote and see what we thought if Madden, the company that makes the baby monitors, should they go with the big deal with Babies R Us, take that opportunity, or should they pass on it?
I say no.
Derek, you said no?
Yep.
Okay, how about you, Brendan?
I think Madden should
So
take the
yes.
baby house. Yes.
And then Charlotte?
No.
No from Charlotte. And then Tom, what do you think?
I say that they shouldn't.
Okay, and then I say no too. Okay, Brendan, you got to stick up for yourself.
So at first I was saying no. I was trying to come up with. I feel like everyone was going to say no.
Yeah.
So I'm trying to think of some positives. I think that their product is a good product. They have it refined. They've gotten a lot of good feedback from parents, and I think they've done some good tests, and it's a product that people will buy. Looking at some of the numbers on the cash flow numbers, they looked good. With the Babies R Us opportunity, in 2 or 3 years, they'll have a lot of free cash flow. So those are kind of some of the things why I think it could be that she should go for it.
Okay. So I do have a caveat to my no, and it's only because, I'll just be honest with you, I couldn't figure out how to fill in some of the green fields on the Excel spreadsheet. And that probably may have influenced me another way. I don't know, did anyone else have trouble? And did someone really understand that and were able to do it?
Yeah, I didn't have too much trouble with it, and it was actually really helpful as far as providing more insight into kind of the decision making. Just reading the case study and looking at the exhibits that it gave as far as I don't know what they had on there, if it was a P&L or what they had as far as their projected sales and their cash flow. To me, it helped me figure out that it was actually a lot more of a risky decision than I even felt just as a gut feeling to begin with. Because there was a lot of you'd run through the hypothetical scenarios as far as what you had to do to make it work to make it to the end of the year without running out of cash. And there's quite a few different things that you had to do to make it work.
Yeah.
They ran out of that 1.2 million pretty quick. Well, I mean, it was out by August.
Do you mind me asking, Tom? I don't know if someone else may have the same question. So on the 3A tab calculating the FCF, what do you put in there in the accounts receivable and the inventory for January? Do you take that number from somewhere else, or do you have to calculate that number?
It's actually it was right there in the Excel file, I thought.
Oh, that's probably.
I don't have it pulled up right now. I can pull it up.
I wonder if I can share.
Yeah, so for accounts receivable, and I looked at the answers too to get more understanding. But yeah, you use the receivables, inventory and payables up above. So you use that in your calculation.
So you just pop those. You mean the 500,000 that's up top, or where are you getting those numbers?
Can you share your screen, or do you want me to share
I
mine?
think. Let me try share screen. You guys see it?
Yeah. So what you do for accounts receivables is you do the receivables up above in the assumptions, which is 2 for monthly revenue.
So you just put the number 2 in there?
No. So you use that cell, and you multiply it by the revenue, I think.
Oh.
That's what the earlier formula showed.
Yeah, and the monthly revenue is down below in that financial summary report. So the monthly revenue for January is the 24,500. And so you can actually just use the cell. You don't have to type in that number.
Or you can just say equals.
So you would do cell E. Let me look back at mine. So for January account receivables, you do cell C6 times cell E33. So the revenue for January.
Okay. No, I just didn't know where to get it, so now I understand it. So now I should be able to go through. Okay, thank you guys.
Mm-hmm.
How about those? Who else was for no? I mean, I just, without even looking at those numbers, it just seemed like everything was so sporadic and seat of the pants that it seemed like any month they could just fall apart if things didn't go right.
I agree. I think it was pretty risky, but sometimes.
Yeah, that's how you get the big payoff, right?
Yeah.
Yeah, that's true. I don't know. I guess
But at the same time, you need to plan well. Also, it's not just all luck, you know. So I understand where you guys would say no as well.
plus, if you have a crystal ball, you know that Toys R Us goes bankrupt, and then you know that, okay, partnering with Babies R Us doesn't end up being the greatest idea.
Yeah,
because then you lose all your stores that you're selling out of.
Yeah.
And like, I know obviously we can't use that information in this case study, but I agree with you. I think it was more Madden trying to, I don't know, prove herself and make her contribution because she really didn't do any of the development of the product.
Yeah.
But looking at it as well, like one of the things that was a red flag for me was the inventory and the overhead costs. And I guess the reason that was a red flag for me is because in my current job, I deal a lot with inventory management and stuff like that,
Yeah.
and looking at turnover and looking at reorder points and how much inventory to carry on hand to meet demand and all that kind of stuff. And the fact that she was thinking that she would need to carry 3 months worth of inventory, that was crazy to me, especially with a product where she was talking about how they were already looking at like a Gen 2
Right.
product. And to carry 3 months worth of inventory, it would delay any progress as far as innovation with new generations of that product.
Well,
But
and there's no history. Toys R Us didn't have any history. They don't have any, they don't really know. Everything was a pure speculation on what could sell in the future. So they're basing a lot of their numbers on just pure guesses, which to
Right.
me just you don't go out and spend a bunch of money and buy a bunch of inventory if you haven't even really tested the market yet. I mean, I know they were selling. Have they actually sold to small places yet? Or was
I
that
think they
still in
had.
their plan?
Yeah, I thought they did.
So they had a little bit, but not on the big scale. And the chunk of money that Toys R Us was taking, what they were making selling to the little boutique places as opposed to what they were going to get from Toys R Us, their profit margins were just sliced.
Yeah, margins were a lot lower, which is why it required a lot more,
Volume.
um, units to be sold. I don't know. I think she probably just used a pretty simple equation to guess the fact that, okay, we're selling this many with this many, I guess, stores. So if we can expand that to the 470 stores that Babies R Us has, then it's going to grow at that same rate exponentially, So I think that's kind of where her thought process was. But
Yeah, I also was thinking that they don't really have any infrastructure to support the product. I mean, think about they're going to go from selling just a few units comparatively, and now you're going to have a bunch of people buying this, and there's going to be issues. Who's going to be the customer service side of it? Because they don't have they've got to have a full hotline staffed with a dozen people or so with all the questions that are going to come in on how to set it up, how come it's not working, how can I get a replacement? Because without that, you're going to get a bunch of people who are just going to return it, and then I guarantee you Toys R Us isn't going to keep those returns. They're going to send them back.
Mm-hmm.
So
yeah. I think she mentioned that too as a concern that she had in the case study, because they didn't have any of that at all. And I think it would, and I don't know. I mean, does anybody know if they did or did not? I mean, is this a real case? Like, they're all real cases, right? As far as these actually happen.
Yeah, these are all real that come through that Harvard business school.
I didn't look though. I looked up.
Did or didn't? I didn't check either.
I looked up their website, but I didn't see. Like, it's still in business right now, I think. But I don't know if they sold or they partnered with Babies R Us or not.
So in this question number 4, it says give everyone a chance to kind of share their thoughts and pros and cons to either or. So I guess just, and also what was at stake in this decision? Like, we kind of touched on it, that basically if it's the wrong decision, they could fail as a business. It would probably take them under if it didn't work out right.
Well, even if it did work out, I mean, they lost quite a bit of ownership in the company as well. It was 25% equity to get that 1.2 million. Which to me, I don't know. I don't know how the other two owners felt about it. It didn't really say too much about if they pushed back very hard on the whole decision.
No, you don't really hear anything about the other two.
Yeah, that to me would be probably one of the hardest things too, when you look at kind of gathering that kind of money. They lose a lot of equity. So
I have a question, and it might be dumb. If you take money from investors and you don't, and you aren't successful, do you owe, like, I know you don't have
No.
any money, but do you owe them anything, or are they just out
No.
as well?
I mean, bar you doing something very negligent,
Yeah.
but I mean, I've done that a couple times with friends who, not too much money, but you throw some money in there, and
Yeah.
it's almost like gambling.
Yeah, I'm not sure. I would assume that has something to do with whatever contractual agreement is written up when the money is invested.
Mm-hmm.
But I think if the business goes bankrupt, then as individuals, depending on the type of corporation you set up, would determine what sort of, I guess, responsibility you would have in repaying the investors too. I would bet they have it set up that if it were to fail, then they would just liquidate everything, and the investors that had a bad investment and they lose their money and get what they can.
True.
Out of the assets. But that was the other thing too, like I was saying in the Excel file, when you go to the tab talking about what is it? Let's see what we got here. The 4B, tab 4B, where you can kind of just run through different scenarios to see what would make it work through the end of the year.
Mm-hmm.
Like one of the things that I found that really made it work through the end of the year was the founders' salaries. They have to take a pay cut. They have to take a pay cut. They have to carry less inventory, and there's a few months where they have to either not pay their suppliers or they have to sell off their accounts receivable to like collection agencies to gather money, cash. Otherwise, they run out of cash in August. And it might even have been before that. It's the 3 months of inventory. I can't remember, but
that was one of their struggles, that the accounts, some of these people that they're manufacturing with want their money within 30 days, or
right.
And so they're not, but yet they want to run a 3-month supply, and that's going to get them into trouble.
Yeah, and they talked about Babies R Us didn't, they only paid every 30 days or whatever.
If they actually do, that's what's on the paper doesn't always happen.
Yeah. So that's kind of the cool thing about that Excel file that they provided is you can look at both scenarios. You can look at the 1.2 million investment there, and you can also look at what the cash flow looks like with just the $500,000.
I mean, with the $500,000, but you don't have to do, you're not taking the money, so you don't have to pay. Does it actually look healthier?
They have cash through the entire year
with the 500
without making any changes.
Yeah.
Based on projected sales without Babies R Us, they have cash to the end of the year. So I don't know. To me, kind of looking at the two of them side by side, it makes the most sense to go that route because they can always look for additional funding in another year. Because if they outperform their projection too, then they're in even a better spot. But they could probably just gather more funding from the same investors. They don't have to open it up,
Right, because if those same investors see that they're having success and then they're coming out with new product that's more innovative, then those investors are going to be more apt to reinvest in it, and you're still keeping the shares down, so they're not losing that share equity.
Right.
Okay, so we've kind of done the fourth question. Moving down, or some of it anyways, going down to the next part is based on the Excel sheet, if we increase the EVAT to sales on holding everything else equal, to time payback, will it increase, decrease, remain the same? Okay.
I think if we increase sales and hold everything else equal, I can't remember if it either stays the same or
I think it.
increases. It doesn't
I think
really.
I think it increased the payback time, even though the sales were greater. You incurred much more cost. I thought that's what I did when I did it.
Yeah, that makes sense. In previous classes I've had, like whenever we put together Excel models and stuff, cutting costs, which is what the next question is, kind of skipping ahead. Cutting down on your assets actually always makes a lot bigger impact on the.
We're talking about EVAT, right?
Yeah, I think he misspelled it, but it's EBITDA, which is earnings before interest and depreciation taxes.
Taxes. Yeah, you left the D out of it.
Yeah, he did.
So, are we saying that it time to pay back would increase or decrease?
Let me pull it up.
I think it increases.
I was just punching it in the flow sheet. So it's it's increasing cash flow, but
Well, if you hit, where are you at? If you reset it, oh, do you have the reset button? There's a reset button on there.
no. You know why? Because I opened it up in
Turn
Google
macros off. Oh.
I opened it up in Google Sheets, not in Excel.
So the original numbers were 5, 5, and 25.
Oh, that's why. Because I had done this. It does open up cash flow more when you increase it. Is it working the same on your sheets, on your regular Excel sheet?
Yeah.
Yeah, I was mistaking it for the sales growth.
Yeah, that's when you do the sales. That's what happened because you're selling more product and everything else is staying the same. But when you increase your margin, essentially, of course, you're gonna, without changing anything else, then you'll go up. So that's decrease.
Sure. Yeah, you decrease it. Yeah.
Okay, and then the next one was the NOAA. Sales increase. Would it increase cash flow, or decrease, or remain the same?
So it's asking if you increase your normal operating.
I think it's a decrease. If it increases, what happens to cash flow?
I think it decreases.
That decreases, yeah.
Yeah. Okay. And then it asks, how did each driver affect the free cash flow? I think we kind of went through it. Yeah. Sales increase the time, EVAT increases, and then NOAA would reduce. when you reduce the NOAA, then you can increase the FCS. Okay. Let's see. We talked about the worksheet, teach one another how to approach the question, the model. So the question is, which decision helped you make it to December without running out of cash? And Tom, was it you were talking about decreasing the salaries? Is that what you did to kind of make it happen?
Yeah, I decreased salaries 10% every month of the year, and I decreased the inventory levels to 1.5 months from 3. And then I sold my accounts receivable 1 month out of the year, and I deferred payments to suppliers 2 months out of the year.
And that got you through.
Yeah.
Anybody else do something similar or something different?
I reset mine on accident. I think I did 2 months of inventory. And then I don't think I only cut salaries on like the last 2 months or last 3 months. I think by 15%.
Mm-hmm. So you kept them the same and then changed them in the last 2 months?
I think so. Let me see if no, that doesn't do anything. I know I cut salaries a couple months, but not every month. And then I sold accounts receivable like 3 times. So what's the benefit or con of selling accounts receivable?
Well, the benefit is that you get money right away. You don't have to wait for it. The con is that you lose 10% because you only get 90% of the value.
Okay, yeah.
But if you're strapped for cash, then it's a great way to get money right away. And you also don't have to worry about collecting it. If you have a problem vendor or someone you're selling to that maybe they don't pay on time and you're really strict on your timeline, it can be nice.
So looking at mine too, I guess I didn't, because I just messed around with it just a few different ways. Obviously, you could change things forever, but I got rid of my cut to the salaries for the whole year and just had the decrease in inventory. And then I sold 1 month of receivables and deferred payments 2 months.
Yeah, I mean, as long as there wasn't like a mad rush to buy the items and you could reduce the inventory levels, that seems like it would really solve most of the problems. Just carrying that much inventory just kills your cash flow.
Yeah.
Okay. This one is, after looking at the analysis, has anyone changed their decision based on what we've talked about?
There was something I was going to say before that, before this question.
Mm-hmm.
You could look at also, it's cut down your projected inventory for like the winter months or, in the spring. I mean, statistically speaking, you have more babies in August, September, October time. I mean, so you could have a bigger reserve going into those June, July, and then cut your production down some through the winter months. Does that make sense? Because you don't always have to have that much inventory because you have a steady flow of babies, but you're also there's a bigger window where there's a lot more babies being born and stuff like that. So I think you could, like on that part of it, your inventory, you could somewhat scale to the time of year too, which could in turn make it so you can make it through those lighter months. Does that make sense?
Yeah, so basically, and you know what, you could take it a step further is just ask Babies R Us, look, I don't need to know the history on these type of products. Just tell me your yearly flow. What are your busiest months? What are your slowest months? Because that's really going to kind of be the same for whatever product you're selling in there, besides diapers.
Right.
So that could be a good take on that, just to help forecast a little bit better.
Mm-hmm.
Okay, so these additional questions, have you guys looked at these at all?
I haven't looked at it yet, but I'm looking at it.
I'll just read them. If you guys have any input, then go ahead and throw it out there. Otherwise, we'll move on to the next one. It says, discuss as a group, what strategies have we seen that flatten or lengthen the cash flow curve? Specifically, try to draw the cash flow curves from Dr. John's products, Rent the Runway, and Dropbox as they were described in the case. Just make a rough guess as to the shapes of each of these cash flow curves. I was thinking about Dr. John's, and they were selling what, like 6,000 units a day. So I'm thinking their cash flow was spiking, like wasn't too flat at first. Maybe as they figured it out, it kind of flattened out.
Oh, they were working on really low margins though too, I think.
Yeah, they were selling those things for $6, so they had to be only making maybe $1 or $2. But they also had very little overhead. I think they said there was only like a dozen people running the whole operation, if that, at the beginning time anyways. And then what about Rent the Runway? What was their issue?
I don't know what their curves would look like.
So I remember, did they have to buy the dresses? I can't even remember anymore.
Yeah, I think they bought them on a like discounted price.
But they still had to buy the inventory rather than
They
hoping
did.
that the vendors would come in and just let them have it or let them use it.
Yeah.
Like a lease. Yeah, they had to buy it.
That would mess up cash flow for sure. Okay, the next one, describe to each other what happened to Dr. John's would have happened to Dr. John's if they had decided to build an independent company rather than get acquired. What activities would John have had to do differently? What impact on cash flow curve would these activities have? Flatten or steepen, shallow or deep, increase or decrease time to pay back? So if they decided to build an independent company rather than get acquired. Well, it seems like if they got acquired, they would get a large increase in cash flow right off the bat because of the purchase price or the investment into the smaller companies, usually what happens. As opposed to staying on their own, they would have had to continue to build. It's kind of what I was thinking.
They would have had to scale their business up quite a bit.
Yeah. And that's expensive.
Yeah. So they would have, I would think that they would have needed additional rounds of investing. I think their curve would be pretty flat because of the margins they work
Yeah.
and the production that they would have to go into.
Okay. Good. I'll run to the next one. Discuss the same for Rent the Runway. If the founders of Rent the Runway had been able to convince the dress designers to retain ownership of the dresses, what impact would that have had on Rent the Runway's cash flow curve? Well, that would have been a lot of expenses removed if they didn't have to buy the dresses.
Yeah.
Easier for them to get more dress so that they can make more, like sell from it, if they are able to get the designer.
Yeah, it would open up cash flow and open up their open to buy would be greater, so they could take in a little bit more inventory. And if the demand is there, that always can turn into more sales. Okay. And what about Dropbox? Let's say, what decision did Drew Houston make in Dropbox to favorably impact the cash flow curve? Did he is it they were just, one size fits all, and they were debating on whether to make special premium accounts, and is that, I wonder if that's what it's referring to?
Not sure. I'll be honest with you. I got too many cases in my head.
I know, I'm trying to remember.
Aren't one of you taking the 383 too at the same time?
No, I'm taking 321.
Oh, that's what it is. Don't you do case studies there too?
Yeah, 2 a week.
I'm sorry.
So I can't remember the specifics anymore. I remember it for the week.
And then it's purged.
Yeah.
Okay. So that's basically it. I think we hit everything that we needed to hit. Thank you guys for helping me out on the Excel spreadsheet. I took like a day and I took a day off and I went back to it. I'm like, I'll just ask the guys when I talk. But are there any other questions that someone might have had that we can help out on, or last comments?
The only other thing is, did we have a group assignment to turn in for this?
Yeah, we do, and I didn't quite understand what the asking.
Yeah, because I didn't even think there was 3 scenarios we were looking at. Was there 3 scenarios? I thought it was just 2.
Yeah. Decide what you would do if given the opportunity to invest in any one of the 3 strategies on attractive terms. Which would you choose and why? Yeah, I thought they just had either go with Babies R Us or not.
Yeah. Invest in one of the 3 strategies.
Do they have one like talk about getting 1.2 million for exchange of 20% of the company? Like
Yeah,
selling
that was the Babies R Us deal. That was how they wanted to move forward, was they would get the 1.2 million for 5%. And then I thought the only other option was 500,000, right?
Well, they were trying to. They already had the 500,000, and then weren't they trying to get 1.5 million from investors, and they only got 1.2? And then there's the Baby R Us deal. Is that the 3?
I don't think so, because I think.
Yeah, I thought they tried to raise 1.5, but they got 1.2 for the Babies R Us.
That's why they were getting 1.2 so that they could meet the demands of Babies R Us. They didn't have the 500,000 yet either. That was just kind of her other option that she knew she could get if she wanted it. So I don't know what it's talking about as far as 3 strategies.
Trying to go
But
through.
we were deciding to invest.
I read it as they were on a round to raise 1.5 and they only got 1.2, and so they were looking to Babies R Us deal to, or are you saying they were trying to raise that money so they could do the deal with Babies R Us?
Yeah.
Okay, that makes sense.
And they hadn't already gone out to get it. She was out kind of hitting the pavement, shaking the bushes to try if she could get.
Right.
Not that they'd actually pulled the trigger on it yet.
She was using the Babies R Us thing to get the investment. Yeah, I don't see the third one then. Is the third one just to do nothing? Just continue on.
Plus, it's asking us if we were given the opportunity to invest. So, as an investor, in any one of the 3 strategies on attractive terms.
Well,
was there other strategies in the case study that she talked about being strategies of what they were going to do?
I don't remember anything.
Yeah.
Well, if we're just deciding between the 2 from the stuff that we know, which investors know they're forecasting, right?
Yeah.
So probably just go with financing 500,000 so they can focus on product development and their supply chain management.
Yeah. Maybe, so what I'll do then is I'll go into the Google Doc and create a new one, and maybe we can just start typing. Everyone kind of contribute something, and then we'll turn it in. It's due Friday, right? Again, I think that worked pretty good. Everyone got to put in their little tidbits into that.
That's fine.
Okay, so I'll do that. I'll create the Word document in Google Docs. I'll share it with all you guys. And then if you didn't do too much last time, feel free to jump in there and do a little more this time. And then that'll relieve some of the people who did a little more this time. So we'll share the load. And then I'll go ahead and turn it in, and I'll upload the link. I'll send the link to all you guys to this video. And then I'll also upload that, because I think we only need one of us to upload it to the for the class, and then it automatically shows that we've all done it.
Yeah, and I can take charge for next week's meeting.
Great. All right. Any other questions? If not, then we'll call it a night, and we'll talk again next Wednesday.
Cool. Thank you.
Awesome.
Sounds good.
Thanks, you guys.
Thanks.
Bye-bye.
Bye.